Welcome to our exploration of behavioral finance and its profound impact on market dynamics. In this video, we'll uncover how human psychology influences financial decisions, often leading to market trends that defy traditional economic theories. Behavioral finance bridges the gap between rational models and real-world investor behavior, offering insights into why markets sometimes move in unexpected ways. By understanding these psychological factors, investors and analysts can better anticipate market shifts and avoid common pitfalls. Let's begin our journey by defining what behavioral finance is and why it matters in today's complex financial landscape. Behavioral finance is a field that combines psychology and economics to explain why people sometimes make irrational financial decisions. Unlike traditional finance, which assumes investors are always rational and markets are efficient, behavioral finance recognizes that emotions, biases, and social influences often drive market behavior. This approach helps us understand phenomena like bubbles, crashes, and herd mentality. By studying behavioral finance, we gain tools to interpret market anomalies and improve our investment strategies. Market psychology refers to the collective mood and attitudes of investors, which can significantly influence asset prices. When optimism prevails, markets may rise beyond fundamental values, while widespread fear can trigger sharp declines. Understanding the roots of market psychology helps us see why markets sometimes behave unpredictably. Factors like news, rumors, and social trends can all sway investor sentiment, creating feedback loops that amplify market movement. Heuristics are mental shortcuts that help us make quick decisions, but they can also lead to errors in judgment. Common biases like overconfidence, anchoring, and confirmation bias often affect investors, causing them to misinterpret information or stick to faulty beliefs. Recognizing these biases is crucial for making better financial choices and understanding why markets sometimes deviate from rational expectation. Overconfidence effect describes how investors often overestimate their knowledge or ability to predict market movements. This bias can lead to excessive trading, risk-taking, and ultimately poor investment results. By being aware of overconfidence, investors can take steps to check their assumptions and make more balanced decisions, reducing the likelihood of costly mistakes. Anchoring bias occurs when investors rely too heavily on the first piece of information they receive, such as a stock's initial price. This can skew their judgment and lead to suboptimal decisions. For example, if an investor fixates on a stock's past high, they may hold on to it too long, ignoring new information. Recognizing anchoring bias helps investors remain flexible and responsive to changing market conditions. Confirmation bias leads investors to seek out information that supports their existing beliefs while ignoring contradictory evidence. This can reinforce poor investment choices and prevent learning from mistakes. By actively seeking diverse perspectives and challenging our assumptions, we can reduce the impact of confirmation bias and make more informed decisions. Loss aversion is the tendency to prefer avoiding losses over acquiring equivalent gains. This means that the pain of losing money often feels more intense than the pleasure of making money. Loss aversion can lead investors to hold on to losing positions too long or sell winning investments too quickly. Understanding this bias helps investors develop strategies to manage risk and emotions more effectively. Herd behavior describes how individuals tend to follow the actions of a larger group, especially in uncertain situations. In financial markets, this can lead to bubbles and crashes as investors collectively buy or sell assets based on what others are doing, rather than on fundamental analysis. Recognizing herd behavior can help investors avoid being swept up in market mania. Prospect theory, developed by Daniel Kahneman and Amos Tversky, explains how people value gains and losses differently. According to this theory, losses loom larger than gains, and people are more likely to take risks to avoid losses than to achieve gains. Prospect theory provides a framework for understanding why investors sometimes make choices that seem irrational from a traditional perspective. Mental accounting refers to the way people categorize and treat money differently depending on its source or intended use. For example, someone might splurge with a tax refund but be frugal with their salary. This can lead to inconsistent financial decisions and missed opportunities. By being aware of mental accounting, investors can strive for a more holistic approach to managing their finances. Framing effect occurs when the way information is presented influences decision-making. For instance, describing a stock as having a 70% chance of success versus a 30% chance of failure can lead to different choices, even though the facts are the same. Being mindful of framing helps investors interpret information more objectively and avoid manipulation. Recency bias is the tendency to give more weight to recent events when making decisions. In markets, this can lead investors to chase trends or overreact to short-term news, ignoring long-term fundamentals. Recognizing recency bias encourages a more balanced perspective and helps investors avoid impulsive moves. Availability heuristic leads people to overestimate the importance of information that comes easily to mind. For example, after hearing about a market crash, investors may become overly cautious, even if the underlying fundamentals are strong. Being aware of this heuristic helps investors base decisions on comprehensive data rather than vivid anecdotes. Representativeness heuristic involves judging the probability of an event based on how similar it is to a typical case. In finance, this can lead to stereotyping investments or overreacting to patterns that may not be meaningful. Recognizing this bias helps investors avoid snap judgments and focus on thorough analysis. Emotions like fear and greed can drive investment decisions, often leading to buying high and selling low. Emotional investing can amplify market volatility and result in suboptimal outcomes. By recognizing emotional triggers, investors can develop strategies to stay disciplined and stick to their long-term plans. Market bubbles occur when asset prices rise far above their intrinsic value, often fueled by investor enthusiasm and herd behavior. Eventually, reality sets in and prices crash. Behavioral finance helps explain why bubbles form and how psychological factors can drive markets to extremes. Just as bubbles are driven by optimism, market crashes are often triggered by panic and fear. When investors rush to sell, prices can plummet rapidly. Behavioral finance provides tools to understand these dramatic shifts and the role of collective psychology in market downturns. Media coverage can significantly influence investor sentiment and market movements. Sensational headlines and breaking news often trigger emotional reactions, leading to increased volatility. By understanding the media's role, investors can learn to filter noise and focus on relevant information. Feedback loops occur when market movements reinforce investor behavior, creating self-fulfilling prophecies. For example, rising prices attract more buyers, pushing prices even higher. Understanding feedback loops helps explain why trends can persist longer than expected and why reversals can be sudden. Contrarian investors deliberately go against prevailing market trends, seeking opportunities where others see risk. This approach relies on the idea that markets often overreact due to psychological biases. By understanding behavioral finance, contrarians can identify mispriced assets and profit from market corrections. Behavioral portfolio theory suggests that investors build portfolios not just for optimal returns, but to satisfy a range of emotional and psychological needs. This can lead to diversified strategies that differ from traditional models. Understanding this theory helps explain why investors may hold both safe and risky assets simultaneously. Market anomalies are patterns or occurrences that cannot be explained by traditional financial theories. Examples include the January effect or momentum investing. Behavioral finance provides insights into why these anomalies persist, often linking them to predictable human behaviors and biases. Institutional investors, such as mutual funds and pension funds, are not immune to behavioral biases. Groupthink, career risk, and incentive structures can all influence their decisions, sometimes amplifying market trends. Recognizing these dynamics helps explain large-scale market movements. Applying behavioral finance in practice means developing strategies to recognize and counteract biases. This includes setting rules for decision-making, using checklists, and seeking diverse opinions. By integrating behavioral insights, investors can improve their performance and resilience in volatile markets. Technology, including algorithmic trading and robo-advisors, is increasingly being used to mitigate behavioral biases. Automated systems can help investors stick to their strategies and avoid emotional decisions. However, technology also introduces new challenges, such as herd behavior driven by algorithms. Regulators are increasingly aware of behavioral biases and their impact on markets. Policies such as disclosure requirements and investor education aim to protect participants from common pitfalls. Understanding behavioral finance helps shape better regulations and a more stable financial system. Behavioral finance isn't just for Wall Street, it affects everyday financial decisions, from saving for retirement to choosing insurance. By being aware of our own biases, we can make smarter choices and build better financial habits. The principles of behavioral finance are valuable tools for everyone. As markets evolve and technology advances, behavioral finance will continue to play a critical role in understanding market dynamics. Ongoing research is uncovering new biases and strategies for managing them. Staying informed about these developments can give investors a competitive edge. In conclusion, understanding behavioral finance is essential for navigating today's complex markets. By recognizing the psychological forces at play, investors can make more rational decisions, avoid common traps, and achieve better outcomes. Whether you're a seasoned professional or just starting out, mastering market psychology will help you succeed in the ever-changing world of finance.